Today we are covering the critical topic of income recognition, specifically the cash versus accrual accounting methods. On the exam, you will not just be asked to define these methods, but to apply them in scenarios designed to trick you. The cash method seems simple, as income is generally recognized when it is actually or constructively received. If you receive a check in the mail on January 2nd for work you did in December, that is January income. But the exam loves to test the doctrine of constructive receipt. This means if income is made available to you without a substantial limitation, you have received it for tax purposes. Imagine your client tells you on December 30th that your check for $5,000 is ready for pickup at their office. If you decide to wait until January 4th to collect it, the IRS and the exam will say you had constructive receipt in December. The income was available, and your choice to delay doesn't change the timing. A substantial limitation, a common point of confusion, is something that genuinely restricts your access. For example, if that check was post-dated to January, or if the client's office was unexpectedly closed, those are substantial limitations, and income would be recognized in the following year. Now let's pivot to the accrual method, which is required for certain businesses, like C corporations with gross receipts over the specified limit. Under accrual, income is recognized when earned, not when received. This is governed by the all events test. The test is met when all events have occurred that fix the right to receive the income, and the amount can be determined with reasonable accuracy. For instance, if an accounting firm completes a tax return for a client in December and sends an invoice, the income is recognized in December, even if the client doesn't pay until March. The right to the income was fixed when the work was completed. The exam will test this with prepaid income. Let's say a client pays you $24,000 on July 1st for a 2-year service contract. Under the accrual method, you can't just report it all when received. There's a special deferral rule. You would recognize the portion earned in the first year, which is 6 months' worth, or $6,000. You can then defer the remaining $18,000. But here's the trap. You can only defer it until the next tax year. You cannot spread it over the entire life of the contract. So, you would recognize the full $18,000 in year 2, not $12,000 in year 2 and $6,000 in year 3. Remember this simple phrase to keep the method straight. Cash is when it's in your hand or could be. Accrual is when the work is through for me. This connects cash to actual or constructive receipt and accrual to the completion of the service that earned the income.